what alternative financing options are available for private businesses? Now, I should tell you, there's actually lots of alternative financing that's available for private businesses, but I'm only going to focus on two today, and they tend to be, they're sort of in the same ballpark, so I thought it would be helpful to talk about both of them. So the first one is factoring, or accounts receivable financing. So this is an instance where, say you have you're a business and you've delivered a product or a service to your client, but they have 30, 60, 90 days to pay you, and you need the cash from that sale sooner than that. And so a company will come along and they'll say, well, no problem. If your invoice is $5,000, we'll give you $3,500 of it today, right now, and when the client actually pays the invoice, we'll deduct our interest, our fees, the $3,500 we gave you, and then we'll give you back the net proceeds. So that's called factoring, or accounts receivable financing. It's become hugely popular in the last couple of years. In fact, as I talk to businesses and factoring companies and try to understand where this market is going and what it's doing, it sounds to me like factoring and accounts receivable financing is sort of here to stay. We, in particular, we're in a province where there's large oil and gas companies that push a lot of business down to small oil and gas services companies. And part of the way the cash flow works is the large oil companies will take 60, 90, even longer potentially to pay an invoice, but these little companies, they've got to pay their field staff, they have to pay their office expenses, they have to pay for their equipment, so they need this cash flow. And if the bank's not going to give it to them, then they have to go somewhere else. And so accounts receivable financing, or factoring, or AR financing has become hugely popular, and I think it's here to stay. I don't think it's going away. I think because the companies have made it so easy to get the financing, you can be approved within 24, 48 hours. You can have a check shortly thereafter. Now, there's some criteria that you have to be able to meet, but generally speaking, very popular. Lots of businesses are taking advantage of it, and most businesses now are familiar with what it is, I would think, and if not, they probably will be shortly. The second type of financing that fits in the same sort of category is what's called POS financing, or point of sale financing. So you know those little credit and debit machines that you see sitting at the front register of a store. What a company will do is they'll look at the history of that credit or debit machine to see how much business actually goes through it, or how much cash, in essence, goes through that machine. And then what they'll do is they'll offer to finance a percentage of that cash flow. And basically what happens is every time that credit or debit machine is used, the funds go into an account, and then that money a percentage of that money gets redirected to pay off an amount of money that was lent to the owner of that business. So both of these types of financing really takes advantage of a future event. So if you're expecting cash, both of these types of financing solutions will let you get your hands on that cash today. Now, there's a cost to doing it, and there's some criteria such as let's talk about the quality of your client. So in the example of factoring or accounts receivable financing, before a company gives you the check, they want to know, wait a minute, the person you're waiting to get paid from, are they bona fide? Are they a company we've heard of? Are they a company that we can believe will actually pay this invoice, or is it some company we've never heard of? If you're dealing with a lot of small companies that maybe no one has ever heard of, you might find it tough to get accounts receivable financing or to factor any of your invoices. If you have a POS machine, the due diligence is fairly light because the history speaks for itself. If your credit card and your debit card machine is generating a stable amount of receipts every day, every week, every month, then a company will feel pretty comfortable that they can lend you the money and expect reasonably to get it back. Some of the things that people don't know are factoring companies or POS companies. A lot of times you have to set up a bank account with that company, so that as your cash flow comes in from your POS machine, or as it comes in from clients, that the funds are being deposited into a bank account that company has access to, so they can take the money out, they can sign for it, they can get it back, and a lot of times this will be a condition of approval. The other thing that you need to know, and I don't know why this happens, yet, but the interest rate is typically quoted in sort of 10-day cycles. So it's going to cost you X amount of dollars. It's going to cost you $3.23 for every 10 days that you have our money. Well, I've never found that math to be really helpful. I tend to think of things more on a month basis. What is the cost per month? Because then I can easily multiply it by 12 and say, well, then this is how much I'm paying per year. Because of the way interest rates are quoted, it can make it confusing to understand what your cost is. But basically, you want to make sure that if you're going to take advantage of accounts receivable financing or point of sale system financing, that you actually do know what the cost is, because that cost comes directly out of your margin. And even though businesses will say, yeah, but I'm only borrowing the money for 10 days, or I'm only borrowing the money for 30 days or 60 days, that money still comes out of your profit margin. And so even though you're paying for it for 10 days, if you're paying for it every 10 days, over the course of a year, you've actually just taken a piece of your margin and given it away in interest. Usually there's an underlying reason why a business needs to factor an invoice or take advantage of POS financing. And so my advice always before we help anyone coming through emilynow.ca is, can you tell us maybe a little bit more about your business? Can you tell us if a major event has happened that has taken cash out of your business that you no longer have to keep it rolling? Or is this a new business, or has something transpired in the business where now sales have grown and you haven't caught up yet with your cash flow to be able to pay for it? So if we can understand what the reasons are for needing to take advantage of that financing, then we can make sure that we can help clients and we can direct them in the right way so that they do get what they need. Make sure that if you're going to take advantage of this kind of financing, that you do fix the underlying problem in your business. If you need true working capital, which is really kind of what this type of money is, then visit emilynow.ca, get your Emily score, and see which banks or lenders you may need to chat with. Accounts receivable financing or factoring, point of sale financing, these are tools to use, but you shouldn't be using them indefinitely because they do cut into your margin, and even though it's easy to use, there's always a cost for doing that. So there's a time and place to use that kind of financing, and then there's a time to wean yourself off of it and move across the street to something like a bank working capital line, where it really will help you bridge the difference between your receivables and your payables and is much, much more affordable. So make sure you have a plan to get your business to the point of where it's cash flowing.